Hello everybody, welcome to Know Your Money. I'm Bronwyn Wayner.
And I'm Craig Finch, and we are from Growth Financial Planning. We hope you enjoy our podcast.
Hello everybody, Tamryn, welcome back. Thanks so much. Tamryn, Head of Retail, Allan Gray. Bron, how are you doing?
Good, thank you.
Good to have Tamryn here. We touched on client behaviour in the last episode and how things around the world, or noise, or newspapers, or all the information we get every single day, and most of it's negative, I think. And then you can react on those negative reports and that. And how do you, on the platform, the Allan Gray platform, do you know how clients behave and have behaved? And do you have clients that have come from you from the beginning, from 1974, and are they still with Allan Gray?
And who haven't reacted.
Who haven't reacted, who stayed the course.
Yeah.
Interesting to know how those...
Yeah, so we have some great examples of clients that have managed to stay the course, and the outperformance relative to the market has delivered incredible impacts of compounding. But maybe I'll answer your first question first, which is, we were in the previous episode, we talked a little bit about some of the things that we're thinking about for 2026, and we spoke about, last year was a pretty good year. We shouldn't maybe necessarily expect it to repeat itself. We said that we thought there was lots of geopolitical noise, and it's got to be, we sort of encourage people to try and resist the temptation to act, as you said, based on the noise. And then the other sort of point we raised was that there have been some trends that have been going on for a long time, and sometimes we tend to anchor what's just happened. And so if I was to try and extrapolate those and make it quite relevant, because that's what we were, telling people about the year ahead, and say, do we see signs of people, for example, in a period where markets returns have been good, do people's attitude towards risk change? Because we tell, I'm sure you tell your clients, this is your plan, your risk appetite shouldn't change. It should be based on your personal preferences and your financial plan. But the reality is, what you see in practice is that people's risk perception changes based on what's just happened.
Yeah.
And we have an example that we've run where, so as I said in one of an earlier episode, our platform was started in 2005. And so what we've done is we've taken cohorts of investors who invested on the platform, and we've said, okay, well, depending on when you start and, the environment that existed maybe just before you started, do you have a different equity allocation? And equity is normally a proxy for risk. And we take out things like age, and we try and sort of put similar balanced clients together, because those types of things can definitely influence risk. So we try and normalize for all the factors that we think should genuinely influence differences in risk appetite. And we actually find that people's asset allocation is different depending on when they first started to invest. So in 2005, if we go back, we know that the years running up to that was actually very good in terms of SA equity returns. The people who invested in that year today still have a higher equity allocation than people who invested 5 years later or 10 years later.
Sure.
And then similarly, people who invested in 2019, now you can remember we were talking in the last episode about how good SA has been last year in terms of returns, but that's coming off a period of almost 10 to 15 years of poor returns.
Yes.
So in 2019, we'd been seeing sort of poor returns in SA for about 5 years. And then interestingly, the allocation to equities for 2019 investors is lower than 2005, and there's no other reason to explain it than the time in which they
and then what was happening at that time.
Or just before, because I think that's what you get anchored to is kind of what's just happened. And as I say, we try to normalize for other characteristics that we think would influence risk. And, that's why, we're very grateful for the partnerships that we've built with independent financial advisors, because, we know that you're engaging with your clients to try and counteract that type
behavior.
of behavior.
Yeah, we definitely are.
And then we think it's even more relevant when you think about age, because we normalize for age in that example, but we take on the platform 49% by number, so not by AUM, because typically older clients have more assets. 49% of clients on the platform are under the age of 49.
Sure.
Gee,
But
that's
what's
good.
interesting is if you think about that, okay, if you are 38 today, and let's say you've been working since you were 23, and that's been 15 years, think of what your worldview looks like. You've only known a period where the rand's been probably, mid double digits, so 15 to 17 or so. You've only known a period where SA equities have underperformed. You've only known a period where the US has been strong. So that's going to be what you think is normal.
Yes.
Whereas if you are 20 years older, you're going to have seen multiple different cycles. So if you take a year like last year, and a couple of years before that was a bad year, and then you overlay that kind of against your age, it just shows you that sometimes the factors that shouldn't influence how you position your portfolios tend to.
So
Behavior is very important.
Very important, yeah.
But it's and that's what you control. As an individual, you actually control a lot. It's and then the other thing I wanted to say on behavior. So we have some examples of the real benefit of just the power of time. So
Sticking to the plan.
yeah, and so there's one it was an actual client example in COVID. So remember what COVID was like, that March 2020, it was a terrible month. SA assets probably went to the cheapest they've been since like the 1960s.
Incredible.
It was dark and it was so uncertain, and we just didn't know how long it was going to take to walk out of it, and the certain cohorts of clients actually switched out of the market. And given the uncertainty, given the fear...
So can we just explain that? So they were basically in equities, so invested, and then they went to cash.
Well, in this particular client that I've got this example of, it was actually, they were in a balanced fund.
Okay.
They were in the Allan Gray balanced fund. And they took the decision in March to switch to cash.
Okay.
Now, what that meant was for the first month, so half of March and about April, they were in cash and the markets carried on going down, so they missed that drawdown. So they're probably thinking that was a good response. But because it's so difficult to predict when things turn around, and actually the markets turned well before COVID got under control. So the market started to turn a couple of months later. And for this individual, you can imagine now they've switched to cash. The world still feels pretty uncertain. The market's now rallied past the point, that you were previously invested. And now you're thinking, okay, but now how do I get back in? When do I get back in? Because if maybe it still feels pretty bad, maybe it'll go down again. And you'd already experienced that other loss. And so this individual waited until the end of the year where, the markets just carried on running and then got back in. And actually what would have happened, and so if you look at the results of, okay, had that person just been in cash the whole time versus if they just stayed in the fund versus the actual switching, the switching was the worst outcome of the three. Whereas the best outcome of the three was just staying invested. And yes, you experience that trauma, and we all know when we see our statement and we've lost money, it hurts. It hurts like almost physical pain. And so you can't try and pretend that isn't how we feel. That is how we feel. Yeah. But sometimes the best course of action is actually inaction, which feels counterintuitive. It does. But it's to resist against that.
Don't look.
Yeah.
Just leave it.
Or you
especially
look,
depending on what that money's for.
You guys the question, and you then you know the why, and you say, okay, I've got to remember the next time this happens that actually the best course of action is likely just to sit.
That's right.
And then the converse of that is we have an example of a client who invested with us right from the beginning,
1974.
1974, I think it was like September 74, and we've got a tract on our website of, it was 100,000 Rand, and today that would be just under 5 billion.
Sure.
And the comparative would have been
100,000 grew to 5 billion, and they stayed.
They just stayed
in
where
that
they
investment.
incredible.
And that's a hypothetical result that we showed. The actual investment was a bit higher, and they had some kind of withdrawals and contributions. It was if I recall, it was a pension fund. But just that power of compounding. And actually, it's the problem with compounding is it's like a little bit like, watching a tree grow. You can't see it for long period. You can't see the benefit for a long kind of period of time. And the real benefit happens in the 10 years before you need
That's right.
to access your money. What do they say? Like Warren Buffett, 95% of his wealth was generated in the last 10 years. And that was just compounding.
Exactly.
And in our example that we have in the website, which tracks this 100,000, if you just put it in the index, it would have been 251 million.
Sure.
So that's also, we say you just want to be a little bit better. And if you are 1% better every day, like if I've been wanting to pick up tennis again. So if I went to tennis lessons today and I got 1% better at tennis every day, which is not going to happen because I'm not going to play tennis every day. But if I did, I'd be something like 35 times better by the end of the year. Sure. So it's just the power of compounding small, differences relative to, where you started or relative to what else you could have done that makes a real difference in 10, 20, 30 years' time.
And I think often people don't know where to start. Well, I don't know how much I should invest, but it's the starting that matters.
And staying.
And just leaving it there. It's either the debit order or the lump sum and then just forgetting about it because that is your 1% starting and then it allows to grow.
Yeah.
So your example said that if that client, the one that started in 1974, tracked the market, just followed the market, it would be 250. But because there was an active manager looking after the money that did a little bit better every year, it went to 5
some years a little bit worse.
Yes,
Isn't
exactly.
it be clear? Some years definitely worse.
That's incredible. That's I heard Tiger Woods the other day say as well. He said, the little things that you do, you can do it for a long period of time.
Yeah.
Little, and you won't see the difference. He said, then suddenly it comes.
Yeah.
And it's a massive difference because you've just been consistently doing it every time. Like your tennis example as well.
Yeah, is that the power of, there's an article about it, they call it the power of 1%. The power of 1% improvements. And it can be applied to sport, it can be applied to how you run your business.
Yeah.
And it can be obviously applied to financial portfolios, just doing a little bit better.
Daily habits, all that.
But
incredible,
I think, whenever I chat to clients, there's always a sense of, okay, well, it's not in my control. But when you look at these types of examples, you realize that your decision, like to start and not to disinvest and not to switch, all these things, you have an outsized impact on the overall, kind of end of day results.
Because you've chosen Allan Gray as your partner. They're going to do all the hard yards and
you've
understand
chosen
it.
to sacrifice what you spend today, to save.
Yeah, you trusted them, let them do their job, and you stay the course, and that's incredible.
And then you've not reacted when you've sort of known what you were focusing on in the long term, and that's why the power of advice is such a critical part in anyone's financial journey, because you want to sit down with someone and say, okay, what am I looking out? What's my long term plan? And if you know what you're working towards, then you can kind of handle the volatility and the noise a little bit better. In the short term. And I think, as we said earlier, I think the noise is going to carry on. We're going to see some crazy headlines
but you've seen
from
them all,
Trump. And
Tamryn, I'm much older than all of you here, but I've seen lots of noise from the 80s. There was Black Monday, and there's been so many different crises around the world. And the markets have always rebounded and done so well. I mean, I remember when inflation was 21% in South Africa. I mean, you can't it doesn't sound possible. Now inflation's 4 or 5%.
Yeah.
I know, and that's to my point of like your age, and that's your worldview.
Yes.
For someone who's 38, inflation's been largely under 5
Yeah.
for, their whole working life.
Yeah.
Whereas you've seen periods where it's probably been 3, 10, 20.
Yeah.
So
exactly.
it can spike.
No, and quickly, but you stay invested, and that's important. Yeah.
Yeah, and I think just to end off with your saying the power of advice, it's any good, even tennis player, they are great themselves, but they have coaches and they have people around them to show them their blind spots, to keep them on the course. And I think financial planning should be viewed the same way, that you've got to do this with a partner, and it shouldn't be a journey you do alone, because you need someone to chat through.
Back to your tennis, I think Rob McDonald spoke about Kyrgios and how he's not on the tour anymore and he's battling with his own issues. And you've got Djokovic, who's had a coach, and all the great players have had a coach throughout their career, and how that coach has kept them through the good and the bad times, kept them on the court, kept them in the game, and they're still around. Where Kyrgios, he's off the court again, and now he's got his own issues.
And he never wants a coach.
Yeah, exactly. Yeah.
Awesome. Thank you so much,
Tamryn,
and thank you for...
Thank you for your time.
No, we really
Brilliant. That was really great. No, thank you.
Thank you.
Thank you for listening. If you have enjoyed this podcast, would like to subscribe, please visit our website, www.growthfp.co.za. The information we have provided in this podcast is our personal opinion. For more detailed information, please discuss your financial situation with a financial planner.